In today's video, we are going to talk about how to get more cash value in a whole life insurance policy. So when it comes to a whole life insurance policy, there are so many different ways that you can set it up, and there's so much confusion around the topic. It is very common for someone to say, I'm interested in a whole life insurance policy because I hear about wealthy people doing this or corporations putting a lot of money here. But then when I see an illustration, it just does not make sense. Like I've got no money in the beginning and it takes 10 to 15 years just to see any type of return on the cash value. So that is the most commonly type of sold whole life insurance policy that's out there. So we'll call this a traditional whole life insurance policy. And when I say a traditional whole life insurance policy, I mean a policy that is just a life insurance policy. Meaning, when you were shown this policy or proposed it, it sounded something like this. Here's a life insurance policy for $1 million. The premium is $20,000 per year. Your cash value, day one, is 0. In year 10, you've paid in $20,000 per year. That's a total of $200,000. Your cash value is $180,000, which is less than the $200,000 you've paid in over 10 years. $20,000 per year times 10 years is a total of $200,000. By the 15th year, you would have paid in what? You've got $20K per year, that's your premium, times 15 years. That's a total of $300,000. So that's how much you've paid in. If you've continued to pay premiums every single year and you have not cashed it out yet, your cash value might be $320,000. So you finally have more than what you paid into the policy. This, again, is a traditional whole life insurance policy. And for someone who's interested in the cash value, meaning I'm researching whole life insurance, I see the core benefits, safe, liquid, tax-free. This is a great example of what not to do, simply because the policy is not maximized for cash value. The priority here with a policy where everything is going to the premium is the death benefit. I'm buying a life insurance policy. I'll also add the commission to the agent will be the highest with this type of setup. The commission is primarily paid on the base premium of a life insurance policy. So commission rates are going to range with different companies and such. They can be as low as 50% with a traditional product and as high as 130% with some companies. So let's say I'm at a high payout level and it's 100% and I make $20,000. So a life insurance policy, traditional, you pay a $20,000 premium every single year. I make 100% commission up front. It's $20,000 in the first year only. There are renewals, but they are much, much lower. But from a cash value component, again, not attractive here. Then you can take what is called a blended policy. So what's nice about this, just from an understanding standpoint, is it's the exact same whole life policy, just blended. So what does that mean, a blended policy? Is this some kind of fancy word to say you can blend it? You can blend it and make something special out of it. Kind of, but not really. So let's assume you're going to pay the same $20,000 in. So step one here is not purchasing a death benefit for $1 million. And me, the agent, telling you it'll cost $20,000. We're going to throw that approach out the window. Instead, you say, here's how much I'd like to pay into the policy, or here's how much I'd like to fund this policy. Maximum cash value is my goal. The death benefit, that is important to me as well. You might say it's not important right now, but the death benefit will be there because it is a life insurance policy. But here's the thing. Instead of me quoting you $20,000, you're saying, here's how much I want to fund it. You might say, I only want to fund it with $10,000 per year. You might say, I want to fund it with $1 million per year. Everyone's different. Let's use 20 just because it's the same as the traditional policy we looked at first. And we'll call this blended policy A, because there's a lot of ways you can blend a policy. This one will not be ideal, but it'll be much better than what we saw the first time around with a traditional policy. So you're going to fund $20,000. Here's the key on this. If you're taking notes, you, the policyholder, can actually choose where your money goes. You can decide if your money goes toward premium dollars or toward this PUA, stands for paid up additions, rider. Premium dollars, like the traditional policy, will not show up in cash value in the first year. Remember the first year cash value with that example? The traditional one? It was 0 right out of the gates. So let's blend it for simple math like this. You're going to pay in 20, 10,000 your premium, and then 10,000 your PUA. Pretty simple, right? I'm just cutting it in half. What will your first year cash value be? First year cash value will be about $10,000. What showed up in cash value? The PUA rider. What did not show up in cash value? The base premium. Now, the base premium eventually does build cash value. We saw that with the traditional policy. Eventually is the key word there because it took 15 years just to get their money back. So here's the difference because we've got money going into PUAs consistently here. The first year, we've got a lot more than the first example. You've got 10,000 instead of a 0. By the 10th year, how much would you have paid in? $20,000 per year times 10 years, you would have paid in $200,000. Your cash value might be worth $220,000, which is more than $200,000. With a traditional policy, what was it at year 10? $180,000, still less than what you paid in. So by blending the policy, we see an earlier break-even point. The break-even point refers to the first year when your total cash value exceeds your total payments. So this example is decent, but it is not ideal in my opinion. It's really just knowing the limits that an insurance company offers. Meaning if I'm you speaking with a life insurance agent and I start to understand how these blended policies work and I see that I can pay money toward my premium or toward my PUA rider, and I see that PUA dollars build cash value much faster, premium dollars do not build cash value. I also see from a commission standpoint that the agent is incentivized to sell a higher premium. So here, the commission would be about half, 10,000. It might be 10.5 or so, not even, it might be 10.3, because there's a small commission paid on PUAs. But less commission there. But again, I see premium dollars do not build cash value. This does. What question would you have if you're paying in $20,000 per year? How do I pay nothing into the premium and everything into PUAs? Can I do that? The answer is no. We cannot pay 0 into the premium and then add PUAs. We do have to pay something into the premium. Well, to be specific, what specifically do I need to pay into the premium? How low can that be? It does depend on the insurance company. The lowest we can typically set it, right around 10% of our total payment. So what that means, let's call this blended policy B. The same 20,000 we'll use. Check this out. We'll pretend this is the exact same company. The difference now is this. Of that $20,000, remember you can choose where it goes. Instead of putting half of it to the premium, I'm going to go as low as I can. And we'll assume we're with a company that allows us to 10x our base premium. The premium is $2,000. Then we've got $18,000 toward the PUA. Now to do this, we will need to add term insurance to the policy. The reason why it has to do with this term, MEC, which has to do with the cash value becoming taxable or not. The purpose of adding term to the policy adds term life insurance, so it raises your death benefit, but it does so at a very low cost, and it prevents this MEC from occurring. So we want to maintain the tax benefits that cash value life insurance typically carries, which is nice. So how we pay for this term, because it might cost $300 or whatever it is per year, is we would just have that premium at $2,300 and reduce the PUA a little bit, for example. But let's continue on here. We'll just use this for simple math right now. You've got a $2,000 premium and an $18,000 PUA. So when we look at everything here, what happens? First year cash value is what? It's not $10,000. It's definitely not a zero. It's going to be closer to $18,000. It does depend on the product. It might be $17,000 or something like that, but you can see what's going on here. We're reducing the insurance premium. By the 10th year, it'll be even higher. That might be $235 or $240, something like that. But we're reducing the insurance premium, getting more money into PUAs, which shows up in cash value immediately. That does begin to compound. I'm seeing more money early and also more money at the year 10 mark. What's also happening here? Commissions being reduced. And this is important to note. I don't always like to talk about this just because it can be a sensitive topic sometimes. But question that comes up with this when I'm interested in a whole life insurance policy and I want cash value is this. Why? Why was I never shown this? That's my question. I was sold a policy. It was either the traditional one or it was a blended policy like option A where I had 50 or 60% of what I paid into the policy in cash value in the first year. It was not maximized. And when you look at corporate models, how corporations set up whole life insurance policies, the designs that are proposed to them, they're very, very rich in cash value, especially up front. And a reason why is because that cash value is an asset on their balance sheet. So if they're going to pay in $1 million, they don't want to have 50% of that, $500,000 in cash value, because that's a $500,000 hit on their profit and loss statement, on their balance sheet, I should say. If it's maximized, the cash value that is, it's there, it's accessible, the negative impact on their P&L statement is minimized. And when we're setting up a whole life insurance policy for a corporation or a small business, it's the exact same product that we would use for an individual. It all has to do with how we set it up. So how you get more in cash value is really just knowing where the money's going, knowing how aggressive it can be set up. All companies have different limits. Some companies allow that minimum premium to be as low as 10%. So smaller companies, we've been able to get it as low as 5%. The lowest we've ever gotten it was like 3.5% or so with smaller carriers. A lot of the major mutuals, you'll see it fall around 10% or so. But just knowing whatever company I'm interested in, how low can you go? And then what are the rules around the PUA piece? I'll end with this. So imagine if you went with this policy, you said, hey, this is maximum cash value. The $20,000 amount, that's what I think I can do, but I'm a little hesitant there. I don't want to be billed for $20,000 every year. Like, what happens if I can't pay? Am I in trouble? Will the policy lapse? Am I going to have to find a way to pay it? Or everything just goes south and I've got uncertainty here? Like, what happens? Because I get it. I used to think the same thing. The PUA piece is flexible. So I can adjust that as time passes. Some companies will allow you to even commit to the premium only. So we've got people we work with, a lot of people will do this. They'll go with a policy like this. We have some that have done exactly this. They want the ability to go up to $20K per year. They commit to $2,000. It's the premium and the cost of the term. So what they're billed for every year is $2,300. Like when the insurance company sends their yearly bill, that's the amount. If they want to pay it monthly, you divide that by 12. And so now I'm paying that premium only. That's what I'm obligated to pay. And then when it comes to PUAs, I add them at leisure. Now the company selection is important here. Not all companies let you do it at leisure. Some require that you add PUAs on your policy anniversary date. Some have rules that if you stop PUA payments, you can't increase them again. So having awareness on different companies, or at least having a conversation on what you want to do and what you'd like to do from a funding standpoint helps when you're speaking with your agent. That way they can provide different options on companies and products, because the name of the game, like what everyone's always interested in when it comes to whole life insurance, is how to get the most out of the policy with respect to the cash value, which if the cash value is maximized, up front you'll have a lower death benefit. Long term, you'll often see a higher death benefit, because what you'll notice at age 100, the cash value and death benefit become equal. So if I beef that cash value up, the long-term death benefit will be very high as well. But again, this is the goal. And then the second item is often flexibility. So the policy does not feel like a burden. How do I make it very flexible? And then after all that, once the cash value is maximized, then we look at examples of using the policy through loans and such, because that part is actually very easy. Whatever you have in cash value, you can access via a loan. We can look at the cost to borrow and such, but if the policy is maxed out first, that gives one more money to then operate with. So that's the fun part. So I hope that this was helpful. Let us know your thoughts. Let us know if you have any questions at all. Please leave them below. And again, as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.